Demand is not fighting normal competitor. It is fighting a dangerous new habit, and that is why this story matters for investor. Because we are not looking at DMart as only a good business. We are looking at DMart as a stock, as an investment asset, and a stock that does not gives great return just because of the survival of business. A stock gives great return when growth stays strong, margin stays healthy, and valuation remain justified. So, real question is not can Blinkit, Zepto, or Instamart deliver grocery fast? Of course, they can. The real question is this: can quick commerce slowly weakens the customer habit that made DMart such a powerful growth story in first place? Because if that habit changes, then future sales growth changes, future profit growth changes, and then stock story also changes. Stay till the end because this is not simple supermarket versus app debate. This is a battle between price and convenience, between profit and speed, and between proven compounding model and a new consumer habit that is growing very very fast. First, let us get one thing absolutely clear. DMart is still a very strong retail company. In financial year 2025, Avenue Supermart reported revenue from operations of about 57,790 crore, EBITDA of 4,543 crore, and profit after tax of 2,927 crore. All these values are in rupees. Okay. And with the EBITDA margin of 7.8% and PAT margin of 5.05%, with the store count of 415 at the end of March 2025. Those are very serious number. This is still a profitable large scale retailer with a real execution strength. Demand strength is simple: low cost, tight control, direct sourcing, fast stock movement, good store economics, and a very strong value promise to customers. Come here, buy more, save more. That is why investor trusted this company for so long. But in stock market, past quality or past returns or past management is not enough. What matters is whether the future growth engine stays strong. And that is where quick commerce enters the story. Now look at the other side. Blinkit has crossed 1,000 stores by quarter 3 financial year 25, and management said it was targeting 2,000 stores by December 2025. That tells you this is not a small niche business anymore. This is a serious scale push. Swiggy Instamart also reported very fast growth in quarter 4 2025. It quick commerce GOV grew by 101% on year basis with 46970 CR, with the average order value of 527 rupees, with the dark store reach at 1021 count, and adjusted EBITDA was with a loss of 840 CR in rupees. That one thing or that one set of number tell you everything. Growth is very strong, demand is real, but profitability is under pressure. And this is exactly where investor need to rethink clearly. We are not buying DMart because it is grocery store. We are buying it because we expect it to grow earning strongly over many years. Normally, when a stock gets a premium valuation, the market expects strong sales, strong profit growth, and long runway. If revenue growth stays in a healthy range, margins stay stable, and store expansion remains productive, the stock can continue compounding. But if growth slows or margins come under pressure, then even a great company can disappoint returns. That is the core investor risk here. Quick commerce does not need to destroy DMart business to hurt DMart stock return. It only needs to reduce growth visibility. It only needs to make the market less confident that DMart can keep growing fast enough to deserve a premium multiple. That is the real danger. This is where many people make mistake. They ask, will DMart survive? Wrong benchmark. Survival is too low a bar. A real benchmark is this: can DMart still deliver the kind of sales growth, profit growth that supports strong return from here? Because if sales growth drop, the margin remains flat or gets squeezed, then profit growth slows. And when profit growth slows, P expansion usually stop. And when P expansion stops, stock return became much more ordinary. That is why investor must watch these three things very very carefully: revenue growth, margin stability, and store productivity. If DMart can still grow revenue at strong rate, hold EBITDA margin near current level, and keep new stores productive, then stock case remain alive. But if quick commerce weakens store visit, split customer basket, and slow urban growth, then the stock may still look very very expensive relative to its future growth plan or path. The business may remain good, but the stock may become less exciting, and that difference is very very important for investor. Now let us compare the model clearly. DMart is built on planned shopping, big basket, family purchases, customer travel to store, delivery cost is basically zero. That supports better economics. Quick commerce is built on urgency, smaller orders, fast fulfillment, dark store rent, rider cost, delivery pressure, discounting pressure. One model is built for efficiency, the other is built for convenience. One wins on cost, the other wins on speed. And today, convenience is becoming very powerful habit, especially in urban India. That is why this threat cannot be dismissed. Now comes the most important international lesson. In UK, rapid delivery and online grocery have had more time to develop. Tesco is a company in UK as a supermarket giant. In financial year 2025, annual report says online sales grew 10% to 6.8 billion. All these figures are in pound. Online orders per week rose to 10% to 1.33 million. Online became 13% of UK's total sales, and Tesco's Whoosh rapid delivery sales almost double, with the service available in more than 1500 stores. Yet, Tesco's ROI like for like sales for the supermarket store still increased 3.1%, and adjusted profit, operating profit for UK and ROI rose to 3016 million. That is in pound. This is very important. Convenience grew fast, but the supermarket giant did not collapse. So, what is the lesson? The lesson is not quick commerce is fake. It is very, very real. The lesson is that strong grocery player can still survive and still grow, but only if it adapts and keep its economic strong. That is why right conclusion is not DMart is finished. That is lazy thinking. The right conclusion is this: DMart is still strong, still profitable, still relevant, but the stock story is becoming harder because the future growth path is no longer as comfortable as it was once looked. And for investors, that matters a lot because a stock can disappoint even when the business does not collapse. That is the key point. So my final view is very very clear. Quick commerce will probably not kill DMart, but it can absolutely attack shopping habit on which DMart business is built on success. DMart still has scale, price, power, and good margins for retail. Quick commerce still has weak profitability, even though its growth is explosive. So this is not a story of death. It is a story of pressure on future growth, pressure on customer behavior, and pressure on valuation comfort. That is why serious stock investors should not ask only, is DMart a good business? They should ask something much more important. From here, is DMart still a strong enough growth story to deliver the kind of return that justify owning a stock at much premium valuation? That is the real battle. That is the real investor question, and that is exactly why this DMart versus quick commerce story deserve much more attention than the market is giving it right now. Thank you very much. See you in the next video. Please make sure you subscribe the channel. Thank you.